All right, good evening. So, as promised, I said I'd post a video on supply and demand, how I trade. I like intraday trading, big fan of it. I like scalping. You can scale in and scalp off those levels. But this video here I'm gonna post is gonna show you how I look at trades, how I look at setups, how and when I identify entries based on supply and demand, and as I reflect on last week, I specifically look at today and Thursday as not trading so hot, specifically because I wasn't really following my strategy. Everyone's got to develop their own little strategy. This video will portray what my strategy is and how I like to trade, and realistically, it's hey, where are these supply and demand levels, and then when and why do I take those trades, whether they're long or short against the market. So I guess simply put, when we go back and say, hey, how do we improve our skills? A lot of it just goes back to reflection and looking at those trades that you weren't very keen on, or like, hey, this didn't work out for me. Why? What was it that I saw at that time? And just reflect on that moment and be like, all right, this is why that trade didn't go in our favor. So I'm gonna do that here, and then I'm gonna make it more of an educational video, so you guys understand what I'm looking at when I'm trading, and this also helps me out a little bit so that I don't mess up and give you guys like false alerts. So trading supply and demand. It's gonna be a short video here on that, and obviously I'm open to some Q&A. Maybe on Sunday we can do this little live, and you guys can throw questions at me, and we can chat through this strategy. And if you guys like it, feel free to adopt it, um, or just you know you know basically blend it in with what you have. So the reason I like supply and demand is one, because it tells me where I want to trade, where I think most of the price action is going to occur, and that's great for us as we buy and sell options, right? So obviously, if we were in a call option, we don't want to be in that consolidated phase. So where can we enter a trade where we're not going to just sit there and just consolidate for a few hours and let theta burn up our premiums, right? So we use this strategy to identify those levels so that we can get away from that and take advantage of price action, or the potential for price action. So this strategy is basically an equation of two parts. We have the where, which is identified with our supply and demand level, and then the when and why, which is basically our price and volume and how those change. The when and why is what I've not that's what I've identified as like my problem. Like, I haven't been looking closely at the when and why as much. It's like, oh, this is the supply level, look for shorts, or this is the demand level, look for longs. uh, the when and why is the second half of that equation, and if you don't pull that into consideration, then you're going to either get stopped out, or you're going to enter in a trade with the hope that it's going to go up. So getting away from hope and more into the technical strategy here, the when and why is probably, as in my opinion, is equally important as identifying those supply and demand levels. So this whole strategy is based on patience. It's an intraday, potentially a swing trade. I don't like to swing trade because of how the market's been lately, but is absolutely open for intraday trading. What we're doing is looking for areas of interest. These areas are going to tell me, hey, this is where heavy buyers and sellers are interested in buying or selling. Like I said, it's all about patience. So we're not looking to enter right away, which has been my issue, especially on yesterday and today. Is we just need to say, hey, we found the where, we win a trade, and then when it hits our second part of our equation, the when and why, okay, we validated this trade, and then we can jump in. What this does is it reduces our It reduces our losses, our risk management is in place, and then also sets us up for a high quality trade. So talking about that, the second component of that strategy, the when and why, that's going to bring more consistency. So when we bring supply and demand, the where, it'll identify certain imbalances in the market, and I'll get to that. But the when and why is identified by the price and volume, and you can use time of sales, patterns, whether that's patterns by the candlestick, or just patterns by the price action itself. But there's a litany of things you can use here. For me, it's just like minor supply and demand levels, or who's winning in this like small scope of the play. And I think that as we progress through this video, you'll be able to see it. So let's talk a little bit about how the where is formed. So where supply and demand levels, those are formed through imbalances in the market. So we're taking a look at IWM here. We're looking at, hey, where are we consolidating? So if you want to take a small scale consolidation, we have consolidation here, right? So this is buyers and sellers are happy with price where it's at. And then all of a sudden we have supply starts to be greater than demand, and then we have price pushed down. So I want to identify those areas on a little bit of a larger spectrum. So that is basically a smaller scale supply level where you have more sellers enter the market to push this price down. So how do we identify these levels ahead of schedule, and then how do we take advantage of that? So imagine you're an institution, a bank, you got some large pockets. You won't, or for most occasion, you can't buy or sell all your positions all at once. So you got to split them all up into smaller positions. This is also why I like dark pool orders, because I know certain levels where these higher orders are put in, whether to sell at a certain price or buy it at a certain price. But at the end of the day, this is a indicator that shows us a potential supply or demand level. But like I said, hey, you're a big bank. Hey, you want to put in an order to buy, 1,000 lots. You're gonna break that down. You're not gonna put them all in at once, because you're gonna scare the market. It's gonna go against what you're trying to do. So you're gonna break them down into like 110 lots or 100 lots of a buy order in. So you're gonna break these down. Those are gonna be identified pretty clearly through supply and demand levels. When we look back, the market's a zero-sum game, right? For someone to win, someone needs to lose. We as retail traders, we provide liquidity for these institutions and banks to fill those orders. So they really can't eat unless we're in there playing with them. So in order for someone to win, someone's got to lose. More often than not, it's going to be us. So how do we put ourselves on their side? How do we get in with them when they're buying? Like, how do we know this? There's a handful of ways to do this. My recommendation is to, one, learn how to read the tape. That puts you in a better advantage. Also learn to read level 2. So as we look through this ticker, I'll jump right into it. Let's start identifying how we set up what you call like a resistance area or supply and demand. So I'm gonna look back here. I'm gonna say, hey, we got IWM here. It's the 30th, so we're on Thursday now, and overnight this thing has gapped down, right? So there's been a imbalance in supply. So now we have supply greater than demand has pushed price from 170, 78, all the way back down to 168. So I like to mark this as a key area. So if I'm sitting at my desk at pre-market, I'm marking this area up, right? So hey, this is a gap. yeah, I forget this statistic, but 92% ish of gaps get filled. So you can play that to your advantage. So you're never going to find one indicator or one thing that's going to put you in a position where you're always right. So you just got to find a multitude of things, right? Hey, we got, MFI is at the lower band here on Justin's transient indicator. We got CCI below 200, or in this case 400, and it's pushing back up. And then one of my favorite indicators here, it's at the bottom here. It basically just validates that price here has a potential for a run up to fill this gap. Because what happens here is we have these these big orders put in, price drops in, and there's a bunch of buyers still in this area, right? So like I said before, in order for someone to win, someone has to lose. So in order for this price to go down, these orders need to be filled. So we've identified the gap. Now we can start identifying some resistance areas. Like I said, when you're identifying a supply and demand level, we're first looking for a balanced market, right? So we have balance here, and we have balance basically in this upper tier here, right? So anytime price comes up, it either gets rejected or consolidates. So we want to take this level and use this as a supply level, right? Because more often than not, we see a rejection, as we've seen Wednesday. So I'll mark that as a red area, and I might identify as resistance, and then based on whatever time. The time I like to use, either 5 minutes, 15, or the 1 hour on intraday trades. But that's going to give me, my first resistance level or my first supply level here. So we got our gap down. We see supply is greater than demand. Now we have a legitimate level with a gap of potential buyers. All right. So what we want to see is the inverse. We want to see demand is greater than supply. So we'll go ahead and fast forward here through pre-market, and we can mark up these areas here because we're obviously interested in this gap, but we're also interested in the alligator closest to the boat here. I'm gonna go ahead and fast forward. So we got get the market open now. What I'll do is I'll adjust my box here and assume that some of these buy orders were filled. We got market pushing up to it and then creating basically a level of imbalance, right? So we have sellers, basically supply is greater than demand here. So these are areas you want to mark up on your chart. So this is a continued throughout the day. These are levels that you want to keep track of. Doesn't mean this is going to be a pure rejection or a pure support. So you might change color up a little bit, but mark these areas up because these are going to be areas of interest as we progress through the trading day. So as price pushes down, we want to identify areas where we have a little bit of consolidation. So we have a little bit of hesitancy here. So we want to start looking. Hey, like this is an area of interest, right? So as we start seeing this, hey, is demand? When does demand trump supply? All right, and I think we start seeing that here around 10:30. All right, so if you have your EMAs on there, boom. So right now we have, and this is all price and volume, right? So we have a strong level of demand right around this level between 166.75 and 167.30. So what we'll do is we'll mark these up as they go. If you're an intraday trader, probably not in anything yet. When I mark, this is personal preference, when I mark up the demand or supply level, if it's a demand, I look at the bearish candle previous and I'll mark that. at the open, and I'll take the wick all the way down. So I'll take the low, and then vice versa. If it's a bearish run down, I'll take the high of the bullish run with the previous open on the bull candle, as you see up here. But this guy down here, this is a very clear demand level, and I'll mark it as such. And basically what I'm looking for is a validation that this is going to run up, and I'm just measuring, hey, when does that demand start to suppress a little and then supply take over. So we'll see we'll look likely see this continue to start to run up as we get a pullback at 1025, and then a push up, so we see buyers rallying on this level here. This is a good level to enter a call option. So it's 1030, let's say, and like, hey, I like this pullback. We have a little bit of a consolidation with I guess you'd call it a doji candle, and then a breakout doji candle, and then a pullback into this area of support. All right, cool. So as this goes up, that's a good opportunity to enter a long position. And I'm keying in, market higher day, and then my stop loss is going to be just below, right? And I'm just eyeballing this, and a lot of this is just, hey, how am I reading supply and demand? I'm not getting out as soon as it hits 166.68. I'm looking at what price does at that level. If it's looking bearish, then I'll exit, and then I'll look for another opportunity as a new supply level or new demand level is going to be built. So ultimately, if we can fill this gap, if I'm, hindsight's 2020, but if I'm looking at this, if we could fill this gap, that's even better, right? So we know we have buyers up in this area that are probably still there from the pre-market. So if we can get up into this area and break into above pre-market highs, then we're likely to continue we're likely to continue moving up into the previous supply level that was built from the day prior. So these levels tell us where to look, and it's up to us to determine when and why we enter these trades. So we'll continue to play this out. So every time we get a little pullback, pullbacks are fine. What we're looking at is, hey, when is it very clear that the bulls are in charge or the bears are in charge, right? We can use EMAs. My favorites are the 8, 21, and 34. So this is a clear indication. So this is a 5 to 1, essentially a 5 to 1 risk reward. And this isn't something that I called out, and that's on me. But as you guys start to get a little bit more familiar with this strategy, all we're looking for is a slight consolidation with a breakout that gives us a supply or demand level. In this case, it's demand. We have a pullback where now we have demand greater than supply. If you miss that, then you have this long wick up with a pullback back into it. It still shows me that, hey, bulls are in control. So even if you were to enter here, as this breaks above the previous bear candles, you're still in a pretty good risk to reward ratio. And at this point, you can move your stop loss up a little bit. But at the end of the day, what you're trying to read here is who's in control. Is it bears or is it the bulls? So as demand is greater than supply, that's what we have here. And that's where we get this run up. There's a little bit of consolidation here at the pre-market levels, but nothing concerning, because I'm still on the 5-minute. I'm still above my EMAs, and we're still riding it up. Now, when we get up to around noon. There's a slight pullback. It's absolutely okay to take profits on here, but it still hasn't broken that 21. Usually when it breaks 21 into the 34 for me is like the reversal. But as long as the 21 holds, I'll probably hold on to a few. And if it bounces off 21, I know it's likely to at least retest the previous high. In this case would be 169.93, and then I'm going to watch it from there. This specific candle retests and then just runs right through. So at 12:20, we have a nice flush candle just pushing past the high a day so far, right into our resistance level. So I'm gonna go ahead and fast forward here. So I'm gonna go ahead and pause here. So you absolutely could have taken this trade on the pullback. You could have taken it on a slight pullback here and a nice rejection off the supply. This is where we're making our trade, right? So we've identified a small where, and this is in the moment. A little bit of consolidation. We got about 10 minutes of consolidation. We got a breakout, pulls back, fights in this area. These long wicks on the downside are telling me that buyers are control at this level, so I'm marking that up. We get a pull back into it at 10:30, and then it just rips. You can wait. You can wait until about 10:50, and we catch it. We got another doji candle, and then we push up, and then this is a good time to enter. So either way, you're not wrong for entering a long position anywhere down here once you identified the when and why. And the when and why is that demand is greater than supply at this level. And honestly, like if you're an intraday trader, all you're looking at is that we come up to either this level and shoot past it, or we come up to the previous resistance or the previous supply level before we exit our trade. So right now we have about 1250. We have a this 1250. We have a kind of an imbalance here where the demand is no longer greater than supply. Right now it looks like supply is starting to either match it, so we get a balance area, or it's starting to overcome it to where we get a drop. So we'll continue to push here. So 1305, it hits the where, and then at 1305, we get a good validation candle on when and why we would enter a short position as this exits our supply level. So we have validated puts in this case, and our take profit is going to be our demand zone. So we'll go ahead and fast forward to that. So if you miss this sharp push out of the supply level, in a high quality setup, you're going to get these double bounces or these double tops, basically a confirmation that hey, bulls own this level, right? So it's okay to wait. The key to this is patience. If you were to enter, hypothetically, let's say two COAs, you enter a trade on the break of this, right? It breaks down, hits your 34 EMA, and then rejects and comes back up. You're most likely closing for a loss. All right, so you're 50-50 on that one. When you get a sharp pullback, and then you get the rejection, and then you look to re-enter here, I think the odds go a little bit more in your favor as it comes back into supply, fails hard because now you see this wick, and then you start to enter on a break of 170.05. Like, oh, look at that. It's a pretty key area. I would draw a support line on that, and then it breaks it. that I think puts the probability in your hands. We're a little bit more conservative on these trades because we want to see these things run. So we'll go ahead and play it. So we got our rejection, looking like supply is greater than demand, and we can identify that because our EMAs can identify that via the price action, pulling into that little pivot zone. We got a slight pullback right into the 21 and a nice rejection. So, it's 1500. I'm looking. I'm also, like, if you don't want to swing these trades overnight, look at that. That's we get a little bit of consolidation in this pivot zone. These pivot zones are a great opportunity for us to either exit the trade altogether. We do not have to see this come all the way down. Can we? Absolutely. You could stay in the trade, but I'd rather take this bit of profit on an intraday trade. I know it's coming down here, and I got pullback. I got to pull back into the this little pivot area. Honestly, I probably would have closed out if it came in and give me any sort of resistance in this area. So we know that initially supply has trumped that demand level, and this is an area where I'd exit. I might not call it out because it's personal preference, whether you want to hold it or not. It depends on what contract you got. When you're intraday trading, you need to give yourself a little bit of time. It doesn't take a lot of time. You can see it happens here in the span of an hour, a few hours or so. But this doesn't always happen. So if you give yourself a week, you're not going to see the advantage of the delta push, but you will give yourself some time and be in a safer contract. So we'll keep pushing on this one, but around 1350, we see the demand is greater than the supply. It retests our previous level of supply. We see the weakness. Bulls aren't there to step up to push it through, and it validates a legitimate level to fill in order to push the price down. So here we have confirmed our when and why. We're at our where, and then we enter puts. All right. And then also you can see that this gap level gets filled, as most of them do. So I can confidently exit the trade on the upside, and then as we enter this down push here, this second top here validates, like, all right, we have supply greater than demand, and that's all we got to measure. So let's say you did swing, you want to swing a trade. Let's see if we can fast forward this sucker. All right, so we got a very strong bullish movement up, right? So we're on Friday. It's today. Strong bullish movement up. Any time you break out of this level, I would probably move this the top end of this supply level. Anytime you break out of the supply or demand levels, it basically invalidates them. So we know that at 950, this thing gets invalidated. But anytime you invalidate a level, you're going to create a new one behind it. So you can move that. That's no longer a support level for IWM. Now we have an open up here where this thing wants to create a new supply level. So looking at 1 July, looking for another trade. Cool. Hey, we got a good run back up. Where's our new supply? So we've invalidated yesterday's supply level, and then I think we can start forming a new one. So if we get a pullback here, we have an imbalance right off the get-go. We have an imbalance So we'll go ahead and draw this one. Well, again, a lot of this is like, all right, cool. We have, you're just drawing support and resistance lines. Instead of drawing a straight line, you capture an area. All right, the area gives you a little bit more flexibility. So I would draw that as a supply level, a new supply level, where this one was invalidated, and now I have a supply level here at the top. So that one's formed. It's got a strong level of support, and there's really no clean trades to take here. So it's okay to sit on the sidelines on this one, because too often than not, like individuals are either going to take this short and it's going to keep running up, or if you're looking at the previous day, like, oh shit, this one broke high, this is going to bounce off of, I'm going to call this, a lot of folks are going to call this one, hey, this is support, right? So it's going to run off support, and I'm gonna get calls now, and then what happens? Boom, this thing just drops. So it's okay for the first 15-20 minutes of market open, just to sit on the sidelines and see the picture that this thing is painting. And so advice getting into any positions, let's wait for it to enter a new wear zone for us. So so the goal is all the stuff in between is price action. This is fluff. We don't want to be trading or entering a trade here. We want to get in the back half of a balance zone and then take advantage of the drops, right? So we don't want to be chasing a put down, because what we end up doing is, you're a big banker, as stock starts to drop, people are selling. Well, who's over there buying, right? Like I said before, this is a zero-sum game. For someone to sell, you need someone to buy. So here at around 10:40 or so, we got a slight imbalance area. Supply imbalance. 10:40 table shift. It's back to the buyers. Creates an imbalance. So we're going to draw out a new demand level. So we still have this validated demand level down here, but again, there's going to be micro demand levels. So what I'm going to do is take a demand level from the previous bear candle to the low of that candle. So the previous bear candle is open to the high of that, or the low of that balance zone in that supply zone. So that's how I would draw my supply, and then I would trade just off of that. So as price pushes out, we have an imbalance where now demand is exceeding supply. So price push up, maybe you're on it, you see a pullback, so we see a bounce out of the supply, we got an imbalance, and then at 10:50 it pulls back, it holds, and then it shows that, hey, buyers are still control, and then you enter a long position, right? And you can absolutely take that trade, right? We know that this is a good area of demand, pulls back into it. Demand is now greater than supply, so we've hit every bit of our wickets. We hit our where, we hit when, and then we hit the why. I'll keep fast forwarding. So let's say you miss that trade. So you miss that trade. If you get in quick, expect to get out quick, right? So we get a double bottom here. It's these two. You got small candles, and then you got some large candles here. These small candles here, right at my demand level, I'm interested in this, right? So what I'm looking for is confirmation where demand is greater than supply as I'd enter. But the fact is that we held this level, created a basically a higher low, and then started rallying up where buyers now own that. That's a strong indication that this thing is going to continue to push higher. So we got that push. As we're looking at it, we're just watching supply and demand levels. It looks like, hey, you know what? Demand is still there. It's still holding above our area. Demand is still overpowering supply, right? So we see there at about 12:15, we got buyers stepping up to the market and really pushing this thing up. So, you know, again, like very strong indication that the market's going to continue to push up to about that 170.89 level. That's where I'd like to take my exit. But I'm also, what's going to trump that is if supply imbalance becomes greater than my demand level. But you know, at 12:15, we see the bulls start to push the price up. You know, our questions are answered. Hey, let's enter some calls. Might have a pullback. Is a good opportunity, either dollar cost average, or you know, hey, re-enter if we miss that first push up. So about 13:05, buyers step up on that second bottom. They push it up, and at 14:45, price hits a supply zone, right? Boom, right there. So I just recalled that from today. As price pushed right back into it, I called it. You know, this happens a lot. Is especially on a double balance, price is going to hit it. Now, if you're playing a zero DTE contract, this gets to like the strategy of what contracts you want to buy in. You know, if you got 0 days to expiration, you need a significant price movement one direction to make you any money, right? Very infrequently are you just going to seize this initial price action, right? So 0 DTE, that's good for like this area here. Outside of that, give yourself a week, you know, 7 to 10 days. If you're going to play an intraday trade for a movement like this, where it bounces off demand level that was created here at 1040, and it bounces off, you're entering trades, and you're going to exit when you know it's going to hit your supply level. So at 14:45, price hits our supply zone. Doesn't mean that we sell everything right away, right? We're going to hold some of the calls. We're going to start to trim. Like this would be, you know, a hold on the 8 EMA and then a push off of it. When it breaks up here, this is a good time to start trimming. We're getting close to our take profit area. Good time to start taking profit and start trimming. But I'm really holding off until we get to this level. So got some, you know, some consolidated. You know, the bar start to shorten. Hey, we're getting a little bit more balance at this level. Sometimes at this point here, it's the end of the week. It's 14:30. Let's cut our position, right? There's a clear formation of a consolidation. At the end of the day, like if you guys take anything out of this, don't trade in a consolidation window. Use the consolidation as a means to identify where you want to initiate a trade, right? That's your where. That doesn't tell you to trade. It tells you where you want to go. And then when you start to see a shift in imbalance between your supply and demand, that tells you when and why. And a lot of times it's identified via like indicators, I got a hot indicator down here. I could share that information with you. You know, where it starts to give me some green bars where it's like, this is pretty good. I got CCI breaking under -100 and then breaking back into it. That's good. Trinity confirms it. You know, it's a good trade. Hey, you know, I enter a long position down here because I use these indicators as a metric to do so. If you don't have these indicators, then the next metric is how can I get a double bounce into the demand zone? Cool, I got it here, and now I'm going to take this thing long and expect it to, you know, find some resistance around, this resistance level, breaks through it, and it cuts right into my supply zone, and I'm out. So I hope this video was informative. You know, this is a period of 2 days, last 2 days, Thursday and Friday. You know, showing you where you can draw out these supply and demand levels. Supply and demand levels basically start with a balance and imbalance shift. So it could be a couple bars. You know, we get a couple bars set up here where we get a balanced price, and then we have a shift out of that balance zone and then a pull back into it. For me, that's enough to enter a trade. You know, we're where we want to be. My stop loss is legitimately going to be, you know, say I want to wait for this double bounce. I come back down into it. Stop loss. My stop loss here is going to be anything that invalidates my demand zone. Now, I want to take this all the way up to supply. So this for me would be a fantastic trade. You're looking at a basically 11 to 5 risk reward. You know, so if you lost a little bit of these trades here, the fact that you're holding to 11 to 5, that's a powerful move up. So it's basically a $3 move up. Sorry, $3.50 move up, and then anything that breaks through my demand zone will invalidate this demand zone, and then I'll cut it for a short loss. It's okay to have losses as long as you reduce your losses and then just look for another opportunity where these balance zones create your demand or supply levels. So in this case, on Thursday, we have a balance zone created. We set our stop to, and you can use ATR to refine your stop loss. And then you're basically entering the trade, and then you're just going to take it. You can start trimming as soon as it comes up and finds a little bit of resistance. But realistically, as you're coming up, you know, all you're looking for, hey, is demand greater than supply? You know, at no point other than here at like 1200, you know, there's a little bit of imbalance, but we still catch and we're still higher. So it would have been okay to cut your losses. Usually you're going to get a double check on your level. So there's absolutely could see a rejection at this level and a pushback down. But at the end of the day, I filled the gap. You know, there's a lot more buyers in this area because we have filled this gap, and it continued to push this price up. So I would say if you're in a place supply and demand, play supply and demand. The only time you exit the trade is if it breaks your stop loss, or if it trips your take profit level. So I'll end the video here. Probably a bit longer than I wanted to make this, but I'm hoping that this sheds some light on how I trade, how I'd like to trade really. We're all pervious to jumping in early. A lot of times I would have entered puts down in here, or got into puts on this supply trump, I guess, over the demand. I would have gotten puts and then just dollar cost average to here. So realistically, stick to your trade strategy. If hey, I don't want to enter puts until the price comes up in here, cool. If you had done that, then your average would have been a lot better, and your risk reward would have been a lot better. So on a day like Thursday, you could have waited. You got a demand level formed, pushes out of it. You took a long position. Comes here, tests your resistance level. Boom, comes up. It shows that there's an imbalance. Rejects. Hey, I'm going to take a short position here. My stop loss is going to be just above. You can use ATR, and I can either take it down here, or I can take it all the way down here. Obviously, this would have worked if you held it, or would have tripped your stop loss, and you will look for another entry down in this area. So not 100%. As you exit the trade, and that's the key. It's like, hey, when do I want to exit this trade? I know that this is a key level from the day prior, or sorry, from the pre-market, and it shows some weakness on the way down, so I'm gonna go ahead and exit that because it's my second trade of the day. I've already hit my goal in my first trade. I can end it on a happy note there. I can take a smaller position just to flex on my account and grow a couple more, just grow it a little bit more with a pretty decent risk to reward. So if you have any questions on this strategy, feel free to hit me up. But I'm hoping this answers some of your questions on how I identify where these supply and demand zones are. But that's just half the equation. The second part is, how do we validate whether these zones are good or not? Because a lot of times, it's gonna run through, and it's gonna keep going. If we there's a lot of occasions where it just busts through your demand level, as it did on Wednesday, and so it's not an exact science. So don't just rely on the where. Really think through, like, hey, who's in control at this spot, right? The where just tells us, hey, this is the area that I'm interested in, whether getting short or long. So it's either going to break through or it's going to reject, right? So all this stuff in between, it really doesn't matter. I'm just focused on this level, stop band red, or the stop band green. That's my demand and my supply levels. Those are the ones I'm really interested in. So it's a great intraday trade. It's the one we should have probably taken. I think we took a short on Thursday down to it and scalped it, and then we probably should have took some long positions, as it created a new demand level, and then demand just exceeded supply into our supply zone that was created from the day prior. So at the end of the day, this strategy works pretty well for me, and the only time I mess it up is the latter part of the equation. It's easy to identify where. The hardest part is when and why would I enter this trade, right? Sometimes it's best to just sit on the sidelines and keep your cash in your pocket for, hey, I'm gonna go ahead and play short. So a lot of times, these guys are just these guys who own or who can move the market. They're just looking for liquidity, and then they're gonna stop everyone out. They're gonna take the liquidity and then push the price. Because how often does it happen where it hits your stop loss and then all of a sudden the stock goes in your favor? Because they have the ability to read your stop losses. They have the ability to trip you out, steal the stock from you, and then push it the way they desire. So at the end of the day, play safe. This is a conservative strategy where we're looking for high quality setups. It gives us a validation on a double confirmation, and before we enter the trade. If it doesn't give us that, then don't enter the trade, and then save your money until it hits the next level. We're not waiting long, and this one movement, it's a 11-to-1 risk to reward, where demand has exceeded supply all the way into that supply level. Take profit, and then we just move on to the next day. If you have any questions, feel free to hit me up. I'll be on Discord on probably Sunday. Probably open this up on a like a live chat Q&A sort of thing. But like I said, hope this video helps identifying when and then, or sorry, where we trade, and then when and how we set up these trades. All right.